AI stocks bounced today, and that carried the market higher after the holiday break. Welcome back to today's market update. The move was real, but it was not a full market surge. The mechanism is pretty simple. Yield stayed contained, oil cooled off, and traders were willing to pay up again for the AI names that can still drive index returns. What buyers have to prove now is that this can last beyond one concentrated tech bounce. I want to see whether the S&P can hold strength while services data keeps the Fed from getting too easy. The key macro check today is the ISM Services PMI, a survey gauge for U.S. services where anything above 50 means expansion and below 50 means contraction. June came in at 54, down from 54.5 in May, so the service economy is still growing, just at a softer pace. The chart shows that the index is off the February high near 56, but it is still well above the 50-line traders use as the growth threshold. That cooling matters because business activity fell to 55.4 and new orders slipped to 55.1, so this is not an acceleration story. Employment moved back into expansion at 51.2, which helps demand, but also makes fast Fed cuts harder to argue for. Prices eased to 67.7 from 71.3, and that helps margins, but the level is still high enough to keep rate pressure alive. Forecasts were vendor-dependent, with 54 on some screens and slightly higher estimates elsewhere. But the actual and prior numbers are the important anchors. For me, this supports stocks near term, but it does not give buyers a free pass if yields start pushing higher again. The Dow Jones Industrial Average finished up about 0.3%, so old economy buyers were still present, just not leading the move. The S&P 500 added about 0.7, and that tells me the main index is holding the tape rather than giving back the holiday rebound. The Nasdaq Composite jumped a little over 1%, and that is the real leadership signal because the AI and chip trade did the heavy lifting. VIX fell into the mid-15s, so traders were not paying up for protection as the close came in stronger. Bitcoin was basically flat near 63,500, which means speculative liquidity was stable, not exploding higher. So the first chart has to be SPY, because the question now is whether the S&P 500 can turn this AI-led bounce into a broader rally check. I still think SPY is stretched up here, even with today's risk on close. The AI rebound helped the index, and softer oil helped the inflation story, but the long-term chart still tells me not to chase blindly. We looked at this same monthly channel 5 days ago, and the point has not disappeared. The 30 years monthly log channel is the main warning sign, because it has kept roughly 95% of SPY monthly closes inside the rails. The June 2026 monthly close above the upper rail was the second monthly close in a row outside that channel, so the market is still trading in rare territory. Outside the channel near the upper rail is where I get careful. It can keep pushing, but the risk-reward is no longer simple. November 1998 through January 2001 is the counterexample, because SPY stayed near that upper rail for a long time before the real reversal showed up. So I'm not calling for an instant break, but back inside the channel would tell me the market is shifting toward a pullback or a long sideways pause. RSI is already around 72.6, so the market is stretched even though momentum has not failed yet. Let me quickly switch to MACD because the trend is still strong, but those MACD lines are at record highs for this monthly window. Now the shorter-term map is where the actual trade decision sits. We've been tracking these same support and resistance lines for a while now, but the upper line has shifted higher and the structure still looks vulnerable to me. That upper resistance line runs from January 30th, 2025 into today, so it is not just a quick reaction high. The lower line is newer, starting from the March 30th low, and that difference matters because the rising wedge is built from a young support line pushing into an older resistance cap. Let's make the recent action easier to see. Price is above both the 50 days and the 200-day moving average, and the 50 days is held for 5 sessions, so buyers still have the trend cushion. The 50 days moving average is the line that keeps the bounce alive for now. The support resistance structure still reads like a conservative rising wedge, and my base case is that rallies are vulnerable until buyers reclaim the overhead area cleanly. The resistance line is the invalidation area for the bearish wedge idea. If SPY holds back above that cap, I have to respect the upside again. RSI is above 50 and rising, so I do not want to pretend momentum is broken. MACD has flipped back toward positive momentum, which gives the bounce more support than price alone. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this lookback, so participation is unusually light. That is why I still lean toward a rejection risk first, unless buyers can absorb resistance with better participation. The momentum chart is the best pushback against my cautious view. MACD has crossed above its signal line, so short-term momentum has turned bullish again. The histogram is positive at 0.286, which tells me upside pressure is improving instead of fading. Price is also above a rising 50 days moving average, so the market still has a valid bounce argument. The problem is the location. A bullish momentum cross under heavy resistance is useful, but it is not enough by itself. With the S&P 500 near record territory and most S&P components not participating today, I want to see confirmation from price, not just the indicator. If MACD stays firm and SPY pushes through resistance, the downside wedge read weakens fast. If price stalls here, the cross can turn into a late bounce signal. The final SPY check is volatility, because this is where a calm-looking index close can mislead people. We already talked about this setup last week, and the range backdrop is still elevated. ATR is in the upper 95th percentile of the last 252 trading days, so this market can travel quickly once a level breaks. That matters more today because oil pressure eased and VIX fell, so the tape feels calmer than the actual range profile. My SPY call is bounce can continue short term, but I do not trust it near resistance unless buyers prove they can hold the move into the close. If sellers take control from this upper area, I would expect pressure to build back toward the first support zone before the market gets a cleaner reset. That sets up QQQ next, because if this broad rally is going to survive, tech leadership has to keep doing the heavy lifting. QQQ is the leadership test after SPY, and today the AI rebound gives buyers a better argument than they had before the holiday. We have been tracking these same support and resistance lines for a while now, and the key update is that tech is still holding a recovery area instead of breaking down. Price is still holding the 50 days area, while the 200-day average sits below as the broader trend floor, so the Nasdaq trade has not lost its main support cushion. The 50 days moving average is the line I care about most here, because a clean close back below it would damage the recovery quickly. The support resistance structure has price in the lower half of the range, so for me this still looks more like a bounce zone than a finished breakout. The resistance line is the upside test. If buyers can push QQQ back toward the middle or upper side of the structure, the AI rebound starts to look more durable. RSI has reclaimed 50, so momentum is shifting back toward buyers, and the bounce has more support than it had last week. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Volume overlay is the caution flag here, because the 5 days average volume sits in the bottom 20% of this lookback, so participation is unusually light. That matters because today's Nasdaq strength came from concentrated AI and semiconductor leadership, not a broad market surge. So my QQQ call is bounce first while this support area holds, but I do not want to chase it unless price confirms above resistance with better participation. The next check is rates, because if Treasury yields push higher again, this exact long-duration tech bounce gets tested fast. TNX is the pressure point F for QQQ, because the tech bounce only works easily if yields stay contained. The ISM Services number cooled, but it did not break the growth story, and the 10-year still sat around 4.48 to 4.49 instead of rolling over hard. So this chart complicates the equity rally. Rates are not exploding higher, but they are also not giving growth stocks a full green light. We looked at this same daily trend channel 5 days ago, and the structure is still holding. SMA 50 is near 4.46 as support, and price is still inside the rising channel in the upper half of the range. That means yield buyers still have a place to defend, and as long as this holds, rate pressure stays alive for QQQ and SPY. RSI is near the 50 line, so momentum is balanced rather than strongly directional, but the MACD histogram is turning up, and that keeps a mild bullish bias in yields. The level I care about is the upper band near 4.57. Holding that area would keep the yield trend in control and make the stock rally harder to trust. A rejection from that upper area would point back toward the midline near 4.48, and that would give growth stocks more breathing room. The range is tight, with daily ATR around 26% of channel width, so once this breaks either way, the move can travel fast. For me, TNX is saying the equity bounce can continue, but it is still rate sensitive and not free from pressure. Next, we need oil, because if crude keeps slipping after OPEC+, that can ease the inflation side of the yield story. Crude is the inflation relief check after TNX, and today it helped the equity tape more than it hurt it. OPEC Plus moved to add another 88,000 barrels a day for August, while Strait of Hormuz flows kept recovering, so WTI stayed around the high 60s instead of rebuilding a war premium. That confirms a softer oil story for stocks, but the crude chart itself is still beaten down, not fully repaired. We were already watching these support and resistance lines last week, and the levels have shifted lower with the sell-off. Price is below both major moving averages, so the moving average backdrop remains defensive, and crude is still trading like a damaged trend. The support area is a decision point now. I still lean towards support holding short term because crude has already been pushed hard to the downside. The resistance line is the first repair test if oil bounces, and rallies can still get sold while price stays trapped under that cap. RSI has been below 30 for 4 straight sessions, so downside pressure has been heavy and crude is stretched. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this lookback, so the bounce case does not have strong participation yet. For the broader market, lower crude eases inflation fear and gives growth stocks more room, but it also says energy demand and supply are no longer giving oil bulls much support. My call is that oil can bounce from this support area, but the burden is on buyers to reclaim resistance before the trend actually improves. That brings us to Nvidia next, because if oil is easing the macro pressure, the market still needs AI leadership to keep carrying the rally. Nvidia is the AI leadership test after oil, because lower crude helps the macro backdrop, but the market still needs chip leadership to carry the rally. Today's AI rebound was helped by the broader semiconductor complex, especially the Broadcom and Apple supply deal story, but for NVDA, the chart is still in repair mode. So I am not treating this as leadership fully back yet. I want to see whether Nvidia can reclaim the short-term trend and pull the Nasdaq with it. We have been tracking these same support and resistance lines for a while now, and the key update is that support moved higher, but resistance also moved higher. Price is below the 50 days moving average, but still above the 200-day, so the short-term read is softer, while the bigger AI trend has not fully broken. The 50 days moving average is the first reclaim level. Until NVDA gets back above it, I treat rallies as repair attempts, not leadership control. The 200-day moving average is the deeper trend floor, and a clean close below that line would damage the recovery quickly. The support-resistance structure has price in the lower half of the range, so for me this still looks more like a bounce zone than a finished breakdown. The resistance line is the upside test. If buyers can push through that cap, the AI rebound starts to look much more believable. RSI is trying to recover toward 50, so downside momentum is easing, but it is not fully repaired yet. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this lookback, so participation is unusually light. My NVDA call is bounce can work from this area, but I need a reclaim of resistance before I call the AI trade back in control. That makes Tesla the next high beta check, because if traders are really leaning into risk, speculative growth should confirm instead of lagging. Tesla is the high beta check after Nvidia, because if the market is really leaning into risk, TSLA should not be deadweight. The company came into this session with strong Q2 delivery momentum after reporting more than 480,000 deliveries and 13.5 gigawatt hours of energy storage deployments. Traders are also watching the robotaxi and AI story again, with attention on the next company updates and the July 22nd earnings call. So the stock has a reason to move, but the chart still has to prove that the move is more than another squeeze. Price is sitting near the upper end of the current structure, and the 50 days moving average is right under price after acting as support today. The 50 days moving average is the line that keeps the momentum case alive. A clean loss back below it would weaken the bullish read quickly. The 200 days moving average remains below as the broader trend floor, so this is not just a one-day pop floating without structure. The support resistance structure is important because TSLA is already near the upper end of it, not sitting safely in the middle. The resistance line is the breakout test. If price clears this area cleanly, the next upside target would likely be around 452.48. RSI has reclaimed 50, so momentum is shifting back toward buyers and the speculative appetite signal is improving. MACD has flipped back toward positive momentum, which gives the bounce more confirmation than price alone. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this lookback, so participation is still unusually light. My TSLA call is continuation first while price holds the 50 days, but I would not trust the move fully unless it clears resistance with stronger participation. For the whole tape, that means Tesla supports the risk-on story, but it also shows why the market still needs follow-through before the rally gets a clean pass. Here's where I land after the full tape. The rally worked today, but I still do not want to chase SPY into resistance. The market had help from AI leadership, softer oil, and a calmer VIX, but breadth was not strong enough for me to ignore the chart risk. The primary read is still that rallies are vulnerable while price stays below the main overhead area. The overhead resistance cluster near 755.9 is the first real test, and that is the zone where I expect sellers to try again. Again, price can keep pushing higher, but I would not blindly chase it into the 756 to 760.4 resistance cluster without confirmation. The upper Bollinger area is part of that warning because price is already pressing into the upper side of the range instead of starting from a cheap level. RSI at 57.6 is not extreme, so momentum is not screaming sell right here. But the stochastics are already hot, and MACD is constructive, so the message is mixed, strength is real, but the entry is late. Again, the whole question is whether buyers can actually absorb the overhead resistance area, or whether this turns into another rejection. The macro backdrop helps the bulls at the margin, because oil cooled and yields were not disruptive today. But the ISM Services data still kept inflation and Fed caution alive, so the macro driver does not replace the level. For me, the line in the sand is a clean reclaim above primary resistance around 756. If that reclaim does not happen, I still give sellers the benefit of the doubt near this reversal area. Now I want to shift the chart forward and connect this setup to the next move. The path I am tracking first is a rejection from this resistance area, with price starting to work back toward nearby support. The support cluster around 741.4 is the first reaction zone I want to see tested if sellers take control. That support area is where buyers need to prove the pullback is controlled, not the start of a larger break. Again, I do not need a dramatic first drop. I need sellers to keep control after the rejection and carry pressure into the close. The secondary support cluster near 725.7 becomes the next downside area if the first shelf fails. The larger downside path starts opening up if 741.4 gives way and the market cannot reclaim it quickly. The open gap around 659.6 to 671.5 is still unfinished business, so the downside risk is bigger if support breaks with force. The upside alternative is simple. Buyers need to reclaim the 756 area and hold it, not just spike through it intraday. The upper resistance cluster around 769.1 starts to matter only if that reclaim holds and sellers stop fading the move. So my final read is this: bounce can continue, but below the 756 area I still treat the rally as vulnerable, and I want proof before calling the breakout safe. That is the market update for today. Watch the 756 area, watch yields, and watch whether AI leadership can keep doing the heavy lifting. Trade carefully, stay flexible, and I will see you in the next market update.